welcome to the OxIgnite Podcast hosted by Yusuf, Raza, and Michael Hutson, two entrepreneurial MBA students at the University of Oxford. Together, we navigate the dynamic journeys of Oxford-linked founders, venture capitalists, and trailblazing innovators. Our mission: to fuel the fire in Oxford's next generation of boundary-pushing change-makers. Our third guest on OxIgnite is Jordan Schlipf, the founder and CEO of Rainmaking Venture Studio, which is a part of the Rainmaking Family. Rainmaking Venture Studio is an investment-only corporate venture builder which combines the scale strengths and deep domain knowledge of large corporations with the RVS team's proven process of venture building. Together with large corporates, RVS develops new future-proof business models that have the potential to contribute significantly to group profits within 5 to 7 years. In this episode, discover Jordan's entrepreneurial journey, from VC to academia to founding his own startup studio. Jordan generously shares a few of the valuable lessons that he learned from his early ventures, and his thought process as an investor and the factors he considers when evaluating startup opportunities. Get insights from Jordan's experiences teaching early-stage founders and his observations on the common mistakes they make. Plus, explore Rainmaking Venture Studio's unique approach, its collaboration with large corporations, and the importance of mental wellness in the entrepreneurial journey. Don't miss this episode packed with wisdom and inspiration from Jordan Schlipf, a highly accomplished veteran startup founder, operator, and investor. Get ready, get set, get OxIgnited.
All right. Hello and welcome to the OxIgnite Podcast. So my guest today is Jordan Schlipf. Jordan is the founder and CEO of Rainmaking Venture Studio, RVS, the world's first investment-only corporate venture builder that partners with large corporations to de-risk the process of building new businesses. Since 2007, Rainmaking has built 52 ventures, generating more than 50% IRR with 9 successful exits to date. Some of RVS's partners include Barclays, Mitsubishi Corporation, Lloyds Banking Group, Cargotec, NG, Wilhelmsen, IKEA, and Facebook. Jordan describes himself as a serial tech entrepreneur and early-stage investor who accidentally fell into corporate innovation when founding Rainmaking. First through the network of startup bootcamp accelerator programs, and later with their global innovation consultancy, Rainmaking Innovation, before returning to his true passion and profession, founding and investing in new startups with RBS. Jordan, thanks for joining me today. I'm very grateful for you sharing your time with our audience. To start things off, could you quickly walk us through your personal and professional journey that led to you founding RBS?
Yeah, sure. Thanks for being here. Thanks for having me. Really glad to be on the podcast. So let's go have some fun. So my personal journey, I spent the vast majority of my career as a founder and CEO of various different technology startups. And I've had more than my fair share of failures. But following one lucky exit and having made a little bit of money, I then transitioned onto the investment side. Initially as a business angel, sort of putting very small tickets into a bunch of startups, and then sort of more professionally as a venture partner at a global early stage VC fund. But to be honest, I found the role of a traditional venture capital investor quite slow and quite boring. It's a lot of watching and waiting. And so I ended up sort of leaving venture capital. I then took a break into academia. I suppose I wanted to scratch that itch of should have stayed and done a PhD and become an academic. But I ended up teaching entrepreneurship, education at a bunch of different universities, so an MBA program at Oxford and obviously UCL, MSc, and a bunch of others. I then found academia actually even slower than being a VC. So I left. But the one thing I then ended up doing is setting up my own startup studio. And I've kind of really been obsessed with startup studios, venture builder, company builder models for the vast majority of my career. And the brief rationale why is I feel it really blends the best of the investment side along with the best of the founder side. So on the investment side, you get to leverage, money and sort of get the sort of the knock-on effects of carry and things like that. But more importantly, you also have a portfolio. So you de-risk your own exposure via a portfolio of bets. From a founder's perspective, a startup studio gets me close enough to the things that I really care about, which is the idea creation, like the hands-on building in that 0 to 1 phase, and having a lot more influence and ownership over the startups in our portfolio than a traditional VC would. So for me, I've been sort of obsessed with that. I had my own startup studio back in the day. That's actually how I met Rainmaking. So Rainmaking began in 2007 as a company builder. And when I was running my startup studio in London with a bunch of other co-founders, I got introduced to these Rainmaking guys who'd started way before we did and were pretty damn successful. And so they're like, hey, have you met these like Danish dudes? They're kind of running a company model that, they're doing well. And I got put in touch with them. And I ended up flying out to Copenhagen, and they very kindly gave me basically a day of their time. And we just sat down kind of being very open about, what they had learned over their years of company building, how are they dealing with some of the particular challenges that sort of inherent within that op model. And I was sort of sharing our experiences and our thinking and our thesis. And the studio I was building in London ended up really sort of collapsing on our most successful venture. So we had one venture which was sort of like a home run compared to the other stuff we were tinkering with. And it went on to raise quite a large round in the open market. And most of my founders ended up sort of falling in, the founders of our studio ended up sort of falling in on that venture and running with it. It was in the ad tech space, so personally it was not something I was passionate to become part of the management team of. And then when our studio collapsed and they sort of went off, my other co-founders went off with that venture, that's when I found myself sort of floating around, and I ended up joining Rainmaking as a late co-founder. And today I lead our corporate venture building businesses globally.
All right, so we're going to deep dive more into the world of corporate venture building this podcast.
Sure.
But before we get into that, before we learn more about your experiences as a serial entrepreneur, an early stage investor, your life in corporate innovation, corporate venture builder, I'd like to rewind the clock back to your years at Oxford. How do you think your time at Oxford set you up for future success?
I think when I started my career, which was very a traditional career path, I think it was very clear how Oxford helped. I think as I switched to the entrepreneurial side, it was less clear. So when I, like pretty much everyone in my time, once I finished my degree, I ended up basically going into London and going into the city. I became an investment banker, and there was no doubt that even getting the internship, as an Oxford student and an undergrad, was a lot more opportunities were available. And I ended up in a small investment bank, M&A boutique, corporate finance boutique, where there was a horrendous amount of nepotism. And, I look back at it now and I'm like, not sure it's such a good thing. But the reality was, we had a small firm of bankers. There was probably only about 30 of us. And literally, I think all but two went to Oxbridge. And so the firm had kind of a culture of white males who all went to Oxbridge. I'm not saying that in a proud way, but that's kind of how it was. So in the early days of my career of going into banking, going into the city, going into those sort of traditional career paths at that time in the UK and in London, Oxford opened a lot of doors. There's no doubt about it. In terms of when I switched to sort of taking a founder approach in the entrepreneurial career path, that is not so clear how Oxford remotely helped, because you have to remind yourself, when I was at Oxford, entrepreneurship was never really talked about. There was no entrepreneurship society. I didn't know any founders. I didn't know anyone who became a founder. I didn't know any VCs. Even though the university was weirdly doing some tech transfer, which is sort of deep tech VC type stuff, I'd never heard of it. And I was in the engineering department. Like, I studied engineering. Some of the professors that were teaching me had done some amazingly commercially successful spin outs and gone on to do crazy things, completely oblivious. And I would say the culture at my time in Oxford was much more of, if I'd said to my peers, oh, I'm not going to go in the city, I'm not going to take one of the classic jobs, right? Accountancy, law, consultancy, banking, finance, something along those lines, or a more creative version of that. Well, we're going to go to PR, brand, advertising, right? Join a big firm, do great things, or go into a big prestigious graduate program at like Unilever or a known brand, Shell. The reality is, if I said I was going to do something entrepreneurial, I think raised eyebrows would have happened, and not in a good sense. I think people would have thought I'm crazy and been like, "What the hell are you doing?" So, from that perspective, I'm not sure Oxford gave really much momentum in the entrepreneurial side. Now, I say that there is, without a doubt, I'm sure there are a bunch of investors who, helped make their decision when they looked at my sort of CV and said, "Oh, he went to Oxford. He must be a smart cookie," and were sort of more willing to invest in my potential. But at the same point, I met folks along the entrepreneurial journey where once they found out I'd gone to Oxford, that really worked against me. So that's kind of been my journey.
I'm curious to hear the latter. What ways do you think it worked against you?
You get pigeonholed in the view where people don't think you're going to be rolling up your sleeves and doing the hustle. People think everything you've earned has been easy because of nepotism, and you actually don't know how to work hard or get the job done. And some people just are jealous or dislike it out of principle. And unfortunately, if they're the ones writing a check as an angel, that's not great, because generally people like to follow fun people that look and smell and like them, right? And so if you have some people who have really never gone to university, have been independently successful as an entrepreneur, worked their way up, it's not something that they would sit down and go, "Oh, Jordan went to Oxford. Yeah, I'm going to give him extra 10 brownie points for that."
Okay, I see. So then, after your brief stint as an investment banker and corporate
Yeah.
finance, you then went and jumped into the world of startups. What excited you about the startup world at that time? Why did you decide to walk on the wild side?
I fell into entrepreneurship. It wasn't a conscious decision. That's the truth. So there's a couple of things you need to understand. So I quit investment banking in August 2008, and then September, the financial crisis happened. The world basically melted. I had no idea that was happening, by the way. But it was one of those things where I had come to the conclusion that I didn't want to stay in investment banking. I had no idea what I wanted to do, but I knew that I wasn't going to have the time working the hours I was doing, both physically, but also emotionally, mentally, the space to figure out what would come next. So I resigned, I handed my resignation, and then the financial crisis happened, which I think in reality was a blessing in disguise, because of that, there was no immediate need to get a new job. It was kind of this scenario of, well, the world's melted. If you end up taking 6 months out or a year out, like no one's really gonna like go crazy, especially if your only previous career and professional skill set was you're a finance guy. It's like the financial world has melted. So, and I think that also took a lot of low-hanging fruit or potentially enticing offers off the table. So because the financial crisis happened, I think, there weren't attractive private equity jobs or investment jobs or asset management jobs or other types of financial roles really being, handed out with insane amounts of money attached to them. And so without that distraction, I was like, oh, I'm just going to, sit around and do stuff. And luckily, because I'd been an investment banker, I had the financial cushion where I wasn't worried. Like I didn't need to get a job anytime soon. And a friend of mine who was building this children's pushchair business was like, "Hey mate, you're a finance guy. Could you help me like build a financial model?" And I was like, "Well, there's only so much sitting on a beach and reading books. Like you get pretty bored after a while." So I was like, "Yeah, no worries." So I built him a full op model for his business, and then that sort of ended up being like, well, actually, you need to raise money, dude. And so I was like, well, why don't I help you put together a business plan? And it's like old school business plan days. And so put together a business plan. I said, well, we'll go pitch it to some investors. And I'll tell you what, if you raise some money, why don't you give me like a bit of a success fee for all the work that I've done in building the model, writing the business plan. And, if we get some money in from my work, then you can sort of retrospectively give me a percent or two on the funds raised. And we sort of agreed that in principle. And I learned a lot in the process, which is kind of what I was doing. I had the time. And I'd actually got a job, weirdly, in tech transfer venture capital in Oxford at a fund called H2O Venture Partners. And not long after getting the job, the founders, my buddy who's doing the children's pushchair business, came back and said, "Oh, look, we've actually raised some money, quite a decent amount of money. Like, actually, I've been speaking to my co-founder, Jackie, and she and I have sort of said, you know what, your skill set's really great. We really like you. Instead of just paying you this cash, why don't we convert that to equity? And why don't you join us as co-founder number 3? And I was like, yeah, cool. And didn't really think much of it. And was literally, having just finished a work on a Friday, I was in the pub with the general partner, the managing partner to the fund I just joined. And I was talking to them. I told them about Novibot, like in the interview process and all this kind of stuff. And I was like, oh, actually they raised some money, and Jordan's going to get a new pair of shoes. Like, it's been great. Drinks are on me. And I'll never forget what David, one of the partners, said. He said, Jordan, actually, you have a really rare opportunity to go from root to fruit. You've written the business plan, you've raised the money, there's no more excuses now. You've got the money, you can go execute your plan, and 2 things are going to happen. Either it's going to go really well, and you can invite us on your yacht when it goes well, and we'll celebrate your success. Or 2, it's all going to go wrong, and you're going to realize how hard it is to build a business, and you will then have direct hand experience of being on the other side of the table of what we do, which is way more valuable for us. And actually, we reckon you should go do this. And this is a rare opportunity for you to figure out if you're as smart as you think you are by trying to build this business. And if it doesn't work out, loosely, if we can, you can come back and join the fund. And so I ended up sort of like basically joining this pushchair business, not because I sort of actively chose to build a startup or entrepreneurship. Built that for a couple of years, then I left that, and then I really struggled to become an employee. Is the honest truth. When I left Novibot, I joined a firm as an employee. I lasted 3 months before I quit. I was like, I can't. These people are like, there are bosses telling me what to do. Like, no, I can't do this. So I really struggled to go back to kind of the normal world. And so I wanted to basically build businesses. And that was like 2000. I mean, bear in mind now, that would have been 2011-ish. Like 2009, when I started at the pushchair business, there wasn't really a London tech startup scene. There was not like Silicon Valley, Silicon Roundabout, it hadn't been coined as a term, right? It didn't really exist. Google Campus didn't come into London until 2012. Mm-hmm. So there was never really this idea of me to be, let's build this tech startup, which is now like the thing, like, oh, let's build a software company, a digital company, an app company. This stuff is, Twitter wasn't started until 2006, right? So like this is like very different experience. I ended up falling into a little bit of the really early stage startup scene in London. And I ended up then sort of falling in love with the technology side of that stuff. And because ultimately I studied engineering, I was passionate about science and technology. And so ended up building what is now called tech startups, but it wasn't sort of a conscious choice. It just evolved by other entrepreneurs I was meeting in London and who I was hanging out with. Some of them were running agencies. Some of them were hugely successful at Last.fm and Moo.com. And I was like, bastards. But I became aware through them of things like Facebook, Twitter, Silicon Valley. And then, it grew from there.
So I've got 3 or 4 questions based on what you just said right now. The first one being, when you walked into that arrangement where there were already 2 co-founders and you came in as the 3rd co-founder at a later stage in time, how did that dynamic work out for you?
So getting into the details of Novibot, I'm going to say a few things now with knowing what I know now. I'm somewhat embarrassed by, but it's the truth, right? there were a lot of major red flags. I don't think coming in late was the issue. The major issue was like, there's this phrase where like, if you want to lose money, go into business with a friend.
Mhm.
Step one. Step two, the two co-founders, Chris and Jackie, were actually brother and sister. And neither of them were full-time on the business. I was the only one full-time. All of these now are like obvious red flags of like, what was I doing? This is mental. I had no idea at the time. But I think credit to Chris and Jackie, when I joined and worked my butt off and were building the business, I didn't really ever feel that my voice was less than theirs. But obviously economically things were a bit messed up between us. Yeah, I mean, lots of mistakes were made. Is the
That's right.
short answer.
I mean, that's always a part of the early stage of like your entrepreneurship experience, learning from a lot
Absolutely.
of mistakes. Uh, if you could have gone back in time, if we just focus on the execution aspect of those startups, what do you think you would have done differently now?
Of which startups? Nobibop and Nobibop?
Yeah, I think you were referring to no people
Yeah,
earlier, right?
Nobibop.
Yeah.
What would I do differently now? I wouldn't have joined.
All right.
Weirdly, I think so. I think one of the things that Chris and Jackie really got right was like the nursery industry, which is basically products for babies, right? Not like schools. But the more broad term nursery industry is a really interesting market. It's huge. It doesn't really have any seasonality. It's really robust, right? It's basically linked to birth rates. And I mean, although in some countries birth rates are decreasing, but also even though some birth rates are decreasing, the reality is the macroeconomics behind it, where spend was just exploding. So you had a couple of supporting trends like what we call the boomer generation, or like our parents' generation. They made a ton of wealth, and that was trickling into the market via gifting. So these days, it's not uncommon where grandparents buy like some of the super expensive items like pushchairs and cots and cribs and things like that. And so this whole industry was exploding, and the market timing, the market dynamics were very, very attractive. And I think what Chris and Jackie got really well was the fact that they had a belief off the back of the early days of Bugaboo was that the price could be significantly increased and there could be this whole new premium category that was created, and that would be brand led. And we look back at it now, and it's like companies like Bugaboo, which are huge, and other big brands in the space that have made millions and millions and millions and millions, and if not billions. And where the pushchair now is kind of the price of a small car. It's like £1,200, right? It's like nuts, but that's happened. They sort of saw that kind of before anyone else, even in the industry, really saw that happening, because a lot of people in the industry just didn't think consumers would allow for like the doubling, the tripling of prices with a premium offer. So like kind of like creating a Jaguar Land Rover of pushchairs was like, people didn't think it would work. They did, and they were proven right by the industry. So in many ways, I think their vision was spot on, and it was a very attractive market, and it could have been a very successful business.
Think just you think it was wrong timing as such?
No. I think they got the timing right. I think they got the market right. I think the product. I mean, the problem things with hardware is hard. It's expensive. You're trying to build a very complex piece of, hardware, a children's pushchair, and you have to meet loads of regulatory requirements and laws in different geographies. It's not an easy thing to do. In many ways, software was a lot easier. You sit down and code it and build it. So hardware businesses are expensive and hard, but I thought their thinking was right, and it could have been a very successful business.
Yes. So, if you don't mind, could you also share some more information about Gift Canon
Yeah,
as
what
well?
would you like to know?
could you just elaborate more on what the company did and whom were you selling to and so on?
Yeah, no, so Gift Cannon was a social gifting platform that focused on sort of micro real world gifts. So the concept being is you could send a friend, a beer, a cupcake, cinema tickets, a pizza, along with a small message instantaneously. They would then effectively get a coupon, and they could go into partnering stores, so pubs, ice cream, cafes, cinemas, and redeem that real world gift. So, I buy you a pint, you walk into a pub, flash your phone, and they serve you a pint. That was the concept. It was social gifting, but it was inspired from a combination of things. So we'd seen a startup called, I think it's called Karma, which was then bought by Facebook. But prior to that, Facebook did do something called Facebook Gifts, which originally started with digital things. So they had this whole explosion where people were basically buying like spending $1 and sending people a little image of like flowers or a box or balloons or whatever. And it kind of exploded. And it was this weird like dynamic on Facebook in the real early days where they were making a ton of money with these like digital, basically iconography, which were like digital gifts. And then there was a startup in the US that was using Facebook dynamics and those sort of digital dynamics to then convert that to the real world. And so they started doing that with physical things. And we were like, that's pretty smart. And at the time, like Groupon was pretty big. And so there was also these sort of other types of startups going around and analogs where people were going in store. There was this sort of like couponing type behavior that was happening and it was kind of big. And so we kind of connected the dots really from inspiration of like the digital gifting, the transition to the physical world, which we thought was going to be way more compelling, way more sticky, alongside some of the infrastructure was showing how technically you could do that, right? With sort of couponing and going in store to get your Groupon on, in this case, to basically just collect your gift that someone else had paid for. And that was pretty much it. And so we then started building the business, went on an accelerator program and whatnot. But that was sort of Gift Cannon in a nutshell.
And how did Gift Can end up for you? Like, how did you exit out of the business?
So we wound it down. So Gift Cannon, again, going back to your question, kind of similar, what would I do differently? I wouldn't start it. Knowing what I know now, I wouldn't have done it. Because, the concept never really had, we never really kicked the tires on it properly from the things that I think about now as really being fundamental. When you look at Gift Cannon at the time, it's like, if you're taking a commission on gifts that have a very small ticket size, like average, £5, £7, less than £10, and you might say at best you might get a 20% commission from the merchant on gifts redeemed, you need insane volumes to get to high revenue numbers. You then need massive customer acquisition, you need massive repeat usage, but also things eat into your margin really quickly, because back then, like the digital payments infrastructure was really weak. We don't have things like Stripe and stuff didn't really exist. And so like how you even facilitated the payment processing of micro payments, no one had kind of cracked that. And so what you would be paying like the traditional banking rails to make those transactions was really expensive. And so suddenly, like what margin you'd be making would get like nailed by payment processing fees. You would then look at kind of like merchant acquisition. You'd have to go get loads of merchants in a city. That's expensive. You're burning shoe leather. There's no other way to sign up cafes, bars, pubs. Like you have to just do physical sales. You then need to build up a ton of those. And then you have the issue of how do you reconcile gifts into their inventory management systems? So you then have to integrate into their EPOS terminals. You have to prevent fraud, right? How do you make sure couponing isn't like making them up? It can't be cheated, right? In many ways, you start thinking about this stuff, and actually, like, not many venues back then had internet or even Wi-Fi. And so you were then like, in some of these venues, if your customer which had a coupon on their phone didn't they go into the pub or go into the they wouldn't have mobile reception. There's no Wi-Fi locally. So you then lost, and then there was a lot of things about like integrating into the EPOS terminals was a major issue. And the technology providers like Micros, Squirrel, Bleep, these like big players were like really anti. They didn't have APIs. They didn't want to integrate. And then you had other issues around things like in bars, all the tills are behind the bar, right? You've got the taps and stuff in the pub at the front and behind the bar. And they don't have scanning equipment, right? And NFC didn't exist. So you would then be like giving your really expensive smartphone to a cashier to just grab with their dirty hands and like go behind the bar to like, how did, so some of this basic stuff we hadn't really thought about, like the market, the scalability, the customer acquisition cost, right? How much margin, the cost of payment processing, like some of this basic stuff, like we just didn't think about any of that up front. And you could have easily just like hammered that out. And like knowing what I know now, there's a lot of stuff I'd look at it and be like, nah, it's not the kind of business I want to build. It just doesn't have the right dynamics. But yeah, first time founders by definition suck, myself included. We suck because you don't know anything and you get really excited about stuff. So you chase stuff.
Yeah. Actually, if I share my own experience, what I saw the first time I was doing a startup, I was very fearless, reckless in a way, like not afraid to do things. But the second time, it's like once you have some more knowledge, even though this was just a short stint at Entrepreneur First for maybe 3 months or something, I found out there was a part of me that became more cynical. And maybe if I was doing it the first time, I would have just gone and done it. Whereas the second time around, I was being more thoughtful about it. But then a part of me still thinks, well, okay, logically, this maybe I did the right thing. But who knows if you had just been reckless and just done it, and maybe something might have worked out. Maybe that's an element as well, right? That could be seen as a positive.
Yeah, 100%. I mean, put this way, right? If you'd say what's probably the most common mindset of any investor, it's like basically super cynical. Like, and I mean that in like in the nicest way, right? Which is like you have a bunch of founders constantly pitching you, and by definition, they're hugely passionate. They're trying to sell you the world. They have like these great big dreams, and you're just calling bullshit on all of it. Because generally speaking, at least speaking of my perception of when I'm acting as an investor or have been a VC, and I think it's quite common. I don't think most VCs would say it as bluntly as this, but I think it is true, broadly, generalistic, true, is that the investments I ended up doing is because I couldn't find a reason to say no. I was looking for a reason to say no, because given how much you have to filter, right, how much inbound you get, you're like, single founder, out. I only do co-founders, right? What's their cap table look like? Out. What's the market? Oh, that's done. Out. You're constantly trying to find reasons to kill deals because you're trying to filter through the volume to get to the few needles in the haystack, right? And weirdly, the experience I had every time we made an investment was kind of like, I can't find a legitimate reason not to give them the money. I suppose we have to give them the money now. Right. And I think that's the right mindset as well. This stuff's super high risk, right? So it's the power law of investing. One of your investments will return your entire fund plus your IRR. And it is statistically like super hard to get any kind of profitable VC return. And so every investment you make needs to come from a mindset of it's got to be exceptional. If it's good, but it's not great, don't do it. If it's great, don't do it. You've got to genuinely be like, hey man, there's no legitimate reason why I shouldn't be giving them money right now. Now, I also say that if you're doing early stage investing, I caveat with the fact that there's very little like data. Like it's generally a bunch of co-founders with a really shitty product and big dreams. And there's not much you can do due diligence on. It's more art than science, right? To a degree. Now you can kick the idea on the idea. Is the time right? Is the market size big enough? What's the competition, the landscape, all of the usual things that you need to do. But like after you've done all that and the cap table's good and the founders seem really credible, like there gets to a point where, you just money.
Good. After your entrepreneurship attempts, you then went on to teach entrepreneurship at some elite institutions like Oxford, UCL, and Imperial College. I'm sure you came across a lot of early stage or aspiring founders during that period of time, also along with your investing experience. What were some of the common mistakes that you saw entrepreneurs make at those early stages of their companies? And which mistakes of these do you think are the most dangerous ones?
So look, when I was doing teaching, it wasn't just the universities, just for clarification, it was also across maybe 30 different accelerator programs across Europe, from seed camp to Techstars, a whole bunch. So saw thousands of founders. I think there are two broad buckets. There are first-time founders, and there are second or third-time VC-backed founders, and those are two very different things. But in the most cases, what we're talking about here is the former. It's first-time founders, and first-time founders, as I said before, like myself, suck by default. They suck. They don't know any better. And the common mistakes are basically three broad buckets. They screw up team, the idea is terrible, and they lack the skills to exercise the idea. So from a team perspective, the most common mistake we see is the co-founding team will tend to be a blonde, brunette, and ginger version of each other. They're not actually diverse in skill sets, and their skill sets often don't match what's a requirement of the business model they're trying to execute. But the first mistake is typically it's a bunch of friends. And in London, there was a period in London that would look like, oh, me and my buddy from banking have left banking and we want to do a startup, or we both left McKinsey and we want to do a startup. It's like, okay, two consultants, great. There's no diversity there whatsoever. And then they're like, oh, how do I find a CTO? And you're like, oh, here we go again. And then they're basically trying to find a lead developer and not an actual co-founder. So the first mistake is always team, and they tend to get into business with their friends. The second one is the idea. They don't often have the skills to understand, to evaluate ideas in the right way, to basically just come up with an idea that on paper is remotely credible. The vast majority of ideas are just terrible because they're not thinking about things in the right way because they don't know any better, right? So, like, put it bluntly, when I look at ideas now, one of the most important things I look at is market. Like, there's this old phrase, like Ollie Samwar from Rocket Internet. I wouldn't say, I don't know why I'm quoting him, but it stuck with me. Anyway, I heard him say once, and it is true. He had this phrase where he was like, what's more important, an A team in a B market or a B team in an A market? And it's like, it's very clear. The market's always more important than the team. Because if the market's terrible, there's nothing a great team can do to change the market conditions. If the market is booming, a rising tide floats all boats and even idiots can make money. And you can always replace the team later. So the market is really critical, and that often is described in shorthand versions like timing. Timing is more than half the battle, right? Timing is critical. It's a judgment call about what is good timing. Too early, too late. There is this white window, and you start to get pattern recognition as an investor about what is good timing, and it's subjective. But some of the stuff isn't subjective. Some of the stuff around market size, what's the competition, like what's the business model, like is it going to make enough money, is it really worth the risk of doing, like, that's just basic analytics. And most of the founders don't do that enough and don't understand the kind of market sizes and the growth. Like the amount of founders that do something, and I'm like, so let me talk about the growth rate of the market you're operating in, and it's like it's reducing. So you want to go spend the next 10 years of your life in a business where the market is tanking? Like, you're an idiot, right? You want to be going into a market that's growing and growing quickly over the next 10, 20 years. You have to have a compelling reason, not just for why this year, but why this decade? Right? And if you want to do the startup approach, which is, again, often what that means is if you want to be venture capital backed, which is not the only way, by the way. I am a massive supporter of lifestyle businesses. I'm a massive supporter of broader entrepreneurship, being a restaurateur, having an agency, massive supporter of those things. I do think venture capital tech startup steals way too much of the narrative and way too much of the PR. But if you do want to go into venture capital, you need to understand what that means, which is like back of the fag packet. If I give you £1 million as a VC, I'm looking to be able to get at least 10 times my money back in 5 to 7 years. So if I give you $1 million, I want 10 million back. If I own, just to make the maths easy, 10% of your business, you're selling for 100 million. In order to get 100 million, you'll probably have small single digits of any market share. So it has to be $1 billion market, minimum, to worth getting out of bed for. That is realistically addressable. Realistically addressable. $1 billion minimum. Otherwise, it doesn't work. And the amount of first-time founders that are chasing stuff where it doesn't meet that simple criteria, it's like, what's the point? And then they go, oh, I can't fundraise. Well, yeah, because the idea is terrible. So idea's bad, team's bad, and the final one is lack of skill set. They don't know what they don't know, right? And so being an entrepreneur is a profession, and it requires a very different skill set that very few things will prepare you for in advance. Now, there's a lot of education now that's available that wasn't available years ago. Lean startup, good customer development, good business model canvas, skill sets. There's a lot of legal templates that are available and the legal skills. You need to understand fundraising, and I don't mean like how to do it, but like the mechanics of it and the business models of venture capitals. Like how are they as an asset manager being managed? How do they make money? What's their business model 2 and 20? You need to understand all of that. And you need to understand technology if you're going to build a technology business, even if you're the CEO. I hate CEOs that go, oh, I'm like the CEO, and you're like, you're building a technology business. What do you know about technology? Why are you even interested? I've got a tech guy to do that. They're still in like a VHS world. I'm like, what are you doing? You have to understand, and you have to be able to communicate with the entire tech division of your firm. And if you can't communicate with them, if you can't get their respect, and if you don't understand some of the basics of this stuff, you don't have to be a coder, granted, but you need to understand this stuff. And that's some of the basic skill sets of just more general entrepreneurship. But then there's the things which I think are probably more common failure points, which is like, if you have a founder choosing a B2B enterprise business and they can't do enterprise sales, game over. Because the skill sets to do certain business models are fundamentally different. If they've never done enterprise sales, that's one thing. But if they're not the right person that is going to be capable to thrive at doing enterprise sales, it's failed. Direct-to-consumer models are very, very different, right? It's more analytical, it's more marketing, PPC, content. There's a bunch of different things you can do. So, you need to understand that and geek the fuck out on that and build brands. Customer experience is going to be critical, customer service, more importantly. So, the skill sets needed that are going to be critical for that business model to be successful have to exist with competency within the founding team. And often they don't.
Just to follow
team
up
idea
on,
and lack of skills.
Sorry, could you just repeat that again? Sorry, I cut you.
Yeah, sorry. Just so to conclude, team, as in co-founding team, the idea, and then lack of skills to execute their chosen business model.
Before we get into Rainmaking, just one last question on this aspect.
Sure.
When you talk about the skills aspect, there are a lot of companies coming up now connecting people to executive coaches or experts or so on, right? And even VCs are coming up with their own platforms to connect founders with experts or so on. Do you think it's the skills that the founder has at that moment when you are thinking about investing in them, or do you think about it in terms of skills that the founder can potentially acquire after working with a coach or an expert?
Look, in an ideal sense, they would have them and they're proven. right? If you look, if you're one of the best VC funds, you're going to get the best deal flow, and the deal flow is going to look a hell of a lot better, which basically means you're looking at things and you're going, well, they've got a proven capability of doing X, Y, and Z, and yeah, I'll give them the money. If your deal flow is substandard or of a lower quality, then you're going to have to be making more decisions about investing in their potential and not their present skill set. And you're always going to be making, as an early stage venture capital investor, you're always going to be investing in the potential of the business, because when you invest at seed stage or even at Series A, they've often done very little. I mean, at seed or pre-seed, they've literally done nothing. Like, they're not made much money. They're not made, like, there's a load of stuff they need to do. So you're by definition, kind of the whole job of being a VC is in investing in potential. And that does definitely include the founders and the team, for sure. But if you had the luxury of not having to invest in potential and you could invest in proven things, 100%. But to your point, just because you're smart doesn't mean you can do these things, right? There are a lot of smart people who will never be good at enterprise sales. They're going to be great at other things, but they will never be good at enterprise sales, because it's not an intellect issue. It's a nature thing, right? It's like they're going to thrive at it, they're going to be good at it, or they're not, right?
Mm-hmm. Understood. Now, moving on to Rainmaker. So there are, based on at least like my observation from the website, there are 3 companies in the Rainmaker ecosystem. Correct me if I'm wrong. You've got Startup Bootcamp, which is the world's largest industry-focused startup accelerator network. You've got Rainmaking, which is a corporate innovation and incubation firm, helping the world's most influential companies build and scale new businesses. And then you've got Rainmaking Venture Studio, which is your baby, which you described as an investment-only corporate venture builder, corporate venture building with skin in the game. Could you just very briefly walk us through each of these and how they're different?
Yeah. The Startup Bootcamp is a standard accelerator, startup accelerator network. So very akin to, say, it's basically a clone of Techstars, to put it bluntly. So it's a mentor-driven accelerator program, 3-month program, a cohort of 10 startups at a time. You give them a little bit of money in exchange for a little bit of equity. And, that's been going on for many, many years now, right? I mean, Y Combinator probably started in 2007, although they're not a mentor-driven. Oh, no, they must have started 2005, and then like Techstars probably started 2007. So going on for a while. So Startup Bootcamp is that. So from an industry perspective, we just pivoted as more and more accelerator programs were appearing in Europe, where we started. We were trying to become more competitive around deal flow. So how do we get better startups applied to our programs so that we own equity in better startups and make more investment returns? And so we were the first accelerator program in the world to take an industry view with multi-corporate sponsorship. So we would have like FinTech London, and FinTech London would have Lloyds Bank, MasterCard, Rabobank, and Intesa Sanpaolo, that would then multiple corporates that would sponsor the program. And then we'd have like FinTech New York with different corporate sponsors, Shipping and Maritime Hamburg, Shipping and Maritime Singapore, InsurTech, a bunch of these different industries with multiple corporate sponsorship. And we sort of pioneered that. And the reason why we did that was purely selfish. It was the fact that, rightly or wrongly, if you get loads of big corporate logos, they're like catnip to first-time founders. So if you're like, we're fintech and we've got big shiny bank loans and MasterCard, the better fintech startups apply to your program. And so that was basically it. And then the sponsorship money we got from the corporates increased our operational budget, so we could also run better programs. But that was, again, just all about how do we attract and basically invest in better startups. So that's Startup Bootcamp. Nothing special, nothing complicated there. It's a startup accelerator program. Rainmaking Innovation was built somewhat by accident. off the back of Startup Bootcamp. So as I've already mentioned, probably at the height of Startup Bootcamp, we had something like 80 Fortune 500 companies attached to Startup Bootcamp globally. And they started coming to us saying, look, this accelerator program, it's fun, it's cool, like we're seeing all these cool startups and technologies and business models, but it's not really moving the needle on our corporate innovation challenges. Could you help us do X, Y, and Z? And so it might be like, we're really struggling to build these kind of new capabilities in-house. Could you help us? Oh, we're really struggling to build, new business models ourselves. Could you help us? Oh, we're really struggling to figure out what innovation strategy looks like. Or we're really struggling to partner or collaborate commercially with later stage startups, or we want to invest in startups. How do we even do that? What does a CVC look like corporate venture capital fund? And so Rainmaking Innovation was basically accidentally born off the demand from corporates to meet their innovation needs from Startup Bootcamp. But because it's a consulting business, not an accelerator program, it's its own business model, it's its own business. And so Rainmaking Innovation began off the back of Startup Bootcamp, and today is a full stack corporate innovation consultancy business. So it does everything from innovation strategy, non-programmatic corporate startup engagement, net zero sustainability stuff, venture advisory, a bunch of different things. And that's a consulting business. And then what I do, which is RVS, or Rainmaking Venture Studio, is we basically build new businesses in partnership with a large corporation, but on a no fees basis. So we'll actually invest millions of our own capital alongside our corporate partners as we go from root to fruit. When we mutually, us and the corporate, like an idea, a new venture concept, startup idea, we'll then incorporate a new co in the relevant market. So a UK Limited, a US Delaware Corp, a German GmbH. We will then create venture teams of proven founders. So we'll basically recruit the CEO and a CTO pair that have raised Series A before. And then we sit on the board alongside the corporate and the founders, guiding that process from incorporation through to acquisition. And in the vast majority of our portfolio, the aim is to exit successful ventures back to the corporate partner, typically year 5. So they sort of capture the vast majority of the lifetime value as they grow from year 5 onwards. But we're an investment firm.
Understood. In this case, when you think about a startup founder as such, you think about them having a lot of skin in the game, right? How does it work in your model, where I suppose Rainmaking, RVC, and the company also holds significant equity stake, if I'm not wrong?
You're talking about RVS?
Yeah, in the case of RVS,
Yep.
let's say, I suppose you do some kind of JV with RVS and the corporate company.
So we create a new business.
Right.
The founders get equity from day one.
Okay. All right.
We as investors get equity, and the corporate as the other investor gets equity. That's it.
Okay.
So we split up the cap table between the founders and the 2 investors, the corporate and Rainmaking.
Understood. So I personally find this concept of corporate venture studios quite fascinating, because if done correctly, which is no easy feat, you can combine the innovation and agility of a startup team with the vast resources and reach that a large corporate can provide. However, this concept might be very new to a lot of our listeners. Could you explain the business model of a corporate venture studio in further detail?
Yeah, sure. There's essentially 2 types. There's everyone else and then there's us.
Okay.
Everyone else is essentially a consulting business. So whether you're a BCG Digital Ventures, a McKinsey Leap, a Pre-Hype, you name it, Founders Lane, they are at their core a consulting business. They are essentially, corporates hire them and pay them to build startups as a service. They will get fees. In some cases, they will get fees plus equity. And in those cases, they might make some money and get a little bit of slice of equity in the startup. But predominantly, they're a consulting business, right? They do not, none of those co-invest millions of their own cash into a business. And none of them do not charge 0 fees. right? So the entire corporate venture building market is essentially a bunch of consultancies trying to sell services. What we do at RVS is fundamentally different. We're really unique in the sense that we see corporate innovation as an investment asset class. We never charge any fees. We co-invest millions of our own cash alongside, in some cases, dollar for dollar, pound for pound, with the corporate into the business. The way we structure stuff is also very, very different. We create a new co from day one. We hire a co-founding founding pair who are real founders. We don't use employees from the business. We don't use consultants. There's a load of things we don't do, right? We have the right incentives, the right talent, with the right governance, with the right funding journey. And we do not ignore the last 40 years of learned best practice from private equity and venture capital about the environmental conditions that need to be true for any early stage business to be successful. So to answer your question, corporate venture building has been in a very fast growing industry for the last 10 years. It will continue to grow and boom. Basically, there are consultants and then there's RVS.
So I would like to think that a lot of people who would listen to this podcast would be some of my other entrepreneurially minded MBA students or some young professionals in my network. And I would guess quite a few of those, including me, would be very interested in joining, like a company like RBS. In this case, how do you think uh, one goes about getting a job in venture building or in a venture studio? Do you look for any particular profile or personality traits when identifying talent that can help you architect new ventures?
So again, like I say, if you wanted to join a traditional corporate venture building consultancy, the skill sets they look for and their requirements are very different to what we do at RVS. So RVS, based on our model and our business model, when we have a very small team that sits at the portfolio level, and the only people we hire are ex-founders, ex-venture capitalists, and ideally they've been both, who are genuinely interested and passionate about working with corporates. It's quite rare to find. Because there are some amazing entrepreneurs and founders that still see corporates as kind of like, they have no interest dealing with their bullshit. Because the truth is, it's really complex and hard to work with some of these world's largest companies. So you have to want to do it. And so in our belief, which is our vision and our passion, it's like we believe that if you want to have the biggest possible positive impact on the world, if you really want to change the world, which is ultimately, I think, what every entrepreneur wants to do in their own way, for us, we think the most impactful way of doing that and leaving the biggest legacy is by partnering with today's largest companies. We think that's the way to do it. And there are certain industries that you cannot change unless you're partnering with the incumbents. Right? If you really wanted to change oil and gas, right? How are you going to do that without the oil and gas industry? If you really wanted to change big pharma, how are you going to do that if you're not a big pharma? If you some of these really capital intensive industries like mining or even like just energy installation, right, to a degree, right? It's like power generation. You want to do that by yourself as a startup? Like, really, I mean, some of these industries, like even like healthcare, if you really wanted to have an impact, in our view, you have to work with the guys that are the world's largest companies in those industries today. I think that's not to say that they don't need to innovate and disrupt. They do. They need to change, and that's what we want to help them do. But you've got to want to do that, and look, that's our view. That's what gets us excited. But that doesn't mean it's the one right way. It's just a case of, for us, we're looking for like previous venture-backed founders who ideally have also been professional venture capitalists, investors, who also have a passion or share our passion to work with large corporates and have the patience to do so.
Understood. So now I need to go work in VC for 2 or 3 years before coming back to me for RBS.
Yeah, I mean, look, joining a corporate venture builder as a consultancy is a lot easier, right? you then just sort of fill into the more generic consultancy skill set.
So I'm kind of like very conscious of time here. Just a couple of last questions. So what's, as you rightly mentioned, it's very difficult. It's not easy to work with, some of the largest companies in the world. But at the same time, if you take certain topics like take sustainability or decarbonization, which I know are projects that you all work on, it can have a really large impact when you're working with such corporates in terms of moving the needle. But what's your secret sauce for combining, like all the good things that come with startups and all the positives that come from larger companies? So how do you combine them with the least friction?
Well, so I would say one of the biggest insights we've had is in order to get a large corporate to provide intimate access to their scale strength, so their customer base, their manufacturing facilities, their logistic networks, whatever it may be, their capabilities, to a new code that they do not control is really freaking hard. And the insight we've had, the kind of how we've cracked that nut, is to basically give them a call option. So there is an economic exchange at the heart of our partnership with any corporate, which is to say, we will give you this call option, which allows you to buy us out early, year 4, year 5. We are giving up our convexity. We will not be able to ride this business from year 5 onwards to $1 billion valuation, right? Which is the vast majority of the value of any startup is sort of year 4, year 5 onwards, right? You have this sort of sigmoidal growth curve. We are economically giving that up, and we're giving you a call option. But that call option gives you the exclusive rights to be the acquirer of this business and has a lot of other preferential terms. That means I can't raise money from anyone else. I can't sell to your competitor without your permission. And so it gives you the comfort to be able to then give intimate access to your customer base, your scale strengths, and everything else to this new code, because you know it's a safe environment now. You control where this is going. This isn't just a startup in the wild, right? And so you can deposit IP, you can deposit customers, and you can give access to the new code. And we contractually obligate them to do so because there's an economic trade-off. I pay them my convexity, and they pay me in return with their scale strengths. And it is legally contracted into all of our investment documents.
And in this case, is it the corporate comes with you saying, this is an area we want to explore, or do you also have certain theses that you have yourself where you go and hunt for corporates to partner with?
The vast majority of our portfolio, we start with a corporate partner absent of an idea. And then our job is to understand 2 things about that corporate or that business unit. So like if you work with a bank, the bank will have different business units that have different businesses, right? Corporate banking is not the same as mortgages, is not the same as, private wealth or asset management. These are totally different things. So for a bank, you end up working with specific divisions or P&Ls. If you work with an airline has one business model. They're just an airline. They've got the ops side and then the commercial side where they sell tickets, but like it's one thing, right? So basically, the reality of the situation is, if we're working with a corporate, the vast majority of our portfolio starts with, we need to first understand their medium to long-term growth objectives. So what we're trying to understand is, if we built a successful business, why is the corporate going to want to become the owner and the operator of that startup or that venture 4 or 5 years down the line? So it has to be strategically relevant. It can't be too close to their core. It can't be too far away. There's a level of adjacency that is the right sort of fit for our model, but also there has to be clear strategic understanding at a board level and throughout the business of why this is something they want to own and operate. The second thing we want to understand is their scale strengths. So we want to do our own due diligence on what are those unfair advantages, like distribution, like manufacturing, like real estate, logistics, and so on, that a venture could leverage. And by leveraging it, significantly de-risk the process of building that business. We use those two things, their scale strengths and their strategic objectives, our understanding of that as constraints for our ideation process. We then generate an investable venture concept that we think is a fit for both of those things. And the investable side is still VC. It's still $1 billion plus valuation, timing, like all the conditions that you would look at as a venture capitalist, we look at in the same lens, pretty much. And so we do the ideation piece. That's our profession. Some cases, corporate give us ideas. We have never invested in an idea a corporate has given us, ever. And we try not to waste our time even evaluating them if we can avoid not to. But there are a small number of our portfolio where we've come up with an idea that we really want to build, that we think would fit into the corporate model. And then we go and sell it to like 4 or 5 similar corporates. And then hopefully one of them says yes.
Thank you. This has been such an insightful session so far. To just wrap things up, what's your approach towards mental wellness and stress management? Have you found any activities that work particularly well for you?
Yeah, 5 things. Eat well, which also means don't drink too much. Sleep well. I read this book called, the Matthew Walker book, Why We Sleep. It's transformational. Exercise. I do daily meditation. My preferred app is Sam Harris. And then the 5th one is knowing when to take a break. You have to manage your own energy and interest levels. And if you get burnt out, it's because you didn't manage yourself properly. And you have to have the discipline to know when to take a break, and to look after yourself. But the daily stuff is eat well, sleep well, exercise, daily meditation, and then take breaks.
On the Sam Harris front, I think you're referring to waking up. Right?
Yeah.
Is there any particular aspect of that really resonated with you?
Yeah, I'm a big fan of Sam Harris in general. I like how he thinks. I like his novels, but his book, Waking Up. His book Waking Up was really really quite inspirational for me around how his philosophy. So he's a neuroscientist by training. He's also a philosopher, and I think that science background and understanding deeply how the brain works, and the fact that he comes at stuff with a very non-spiritual, non-secular mindset really resonates with me as a sort of an atheist. So for me, I also quite find his voice quite soothing, and so the tonality of his voice. But he brings a variety of ultimately different practicing techniques, which has variety, which I also enjoy. But really, it's more his philosophy and his mindset. And so it isn't too guru, that hippie spiritual. It isn't too kind of gongy. And so for me, and I just like him as an individual, so it's just my preference. So I have an affinity to kind of his approach and to his way of life. Plus, the app has a lot of other content which I actually find very, very insightful.
And did your time in China and Hong Kong kind of make you? Did you get any Oriental affinities around meditation?
No. I mean, I was born and raised in Hong Kong. Asia is still home, but no, I didn't really get exposed to meditation until a lot later. Really, in my entrepreneurial career, I started reading around. I suppose I got recommended it and was reading Sam Harris and was okay, this is quite good. And it is really important to look after your mental well-being. Mental well-being is not something we talk about often enough in entrepreneurship, because if you want to become a founder of any type, lifestyle business or VC-backed business, it comes with a lot of huge health warnings. It is brutal. And it's not for everyone. My honest opinion is I think you can teach people a lot of the skills of entrepreneurship, but I think there is still fundamentally, you are either a human being that thrives in that huge level of uncertainty and that huge level of just daily stress and robustness, or you don't. And if you don't, get out the pool. It's not for you. If you can't swim, don't get in the pool. So basically, I don't think it's for everyone. And I think that's okay too.
Yeah. Thank you for all the bombs of insights that you've dropped on this podcast. Where's the best place people could reach you if they're interested in having a chat with you?
Yeah, sure. The best place would just be on LinkedIn. Type in my name, Jordan Schlipf. Find me on LinkedIn. Drop me a connect. Please put a little note. And yeah, that's the easiest way to do it.
Sure. I'll make sure to drop that in the notes section as well. So, well, Jordan, thank you for your time. It's been a real pleasure.
Thank you for tuning into OxIgnite. Please reach out to Yusuf, Raza, or Michael Hutson on LinkedIn if you are an entrepreneur with ties to Oxford and want to create more awareness about your venture, or if you are an investor interested in investing in Oxford-linked startups, or if you are a brand that wants to sponsor an episode of the OxIgnite podcast. If you like this podcast, please help us spread the word to your network. We would also welcome any donations to help us scale this podcast. You can donate at buymeacoffee.com/OxIgnite, OXIGNITE.